Hello, everybody. This time we are talking about cost analysis. Cost analysis refers to the process of evaluating the financial implications of various business decisions, projects, or initiatives. It involves identifying, measuring, and comparing the costs and benefits associated with different options to determine the most cost effective and efficient solutions. For data teams, cost analysis is crucial as it helps assess expenses related to data infrastructure, tools, personnel, and other resources, enabling informed decision making regarding resource allocation, project prioritization, and operational optimization. Understanding the principles of cost effectiveness can further enhance this analysis by ensuring value driven decisions. Additionally, grasping the concept of data value can provide deeper insight into the return on investment for data initiatives. And then the types of cost analysis. The first type, activity based costing or ABC, identifies and assigns costs to specific activities within a business. Unlike traditional costing methods, which allocate costs based on a single metric, like labor hours, ABC looks at each activity contributing to overhead costs. This method provides a more accurate picture of how you spend money. The second, break-even analysis, determines the point at which total revenue equals total cost, resulting in neither profit nor loss. This analysis helps businesses understand the minimum sales volume needed to cover expenditure. Third, marginal cost analysis refers to the cost of producing one additional unit of a product or service. It includes variable costs like materials and labor, but excludes fixed costs, which remain constant regardless of production volume. And then we move to the significance of cost analysis. The first, effective decision making. Cost analysis provides the foundation for informed decision making. By understanding where and how resources are spent, businesses can optimize their operations, reduce waste, and allocate resources more effective and efficiently. Second, budgeting and forecasting. Cost analysis is invaluable when creating budgets and financial forecasts. It allows organizations to anticipate future expenses and plan accordingly. Third, pricing strategy. Determining the appropriate price for a product or service relies heavily on cost analysis. Businesses need to cover their costs and earn a profit while remaining competitive in the market. And we move to the purpose of cost analysis in procurement. The primary purpose of conducting cost analysis in procurement is to ensure that a business is paying a fair price or reasonable cost for goods or services based on the actual resources required to provide them. In this process, supplier proposals are reviewed and evaluated for fairness, helping remove guesswork from buying decisions and supporting negotiations with vendors to assess whether a supplier's pricing reflects reasonable and justifiable cost structures. Moreover, regular cost analysis shields businesses from hidden expenses, price inflation, or inefficiencies that could erode profitability. And then how to use cost analysis in business. In business, cost analysis is the process of looking at ways to reduce costs and improve efficiency. It can be applied to a wide variety of areas, including productions, marketing, human resources, and supply chain management. When conducting a cost analysis, businesses typically look at three main types of costs: variable costs, fixed costs, and semi-variable costs. Variable costs are those that fluctuate with production or sales volume, such as raw materials or labor. Fixed costs are those that remain constant regardless of production or sales volume, such as rent or insurance. And semi-variable costs are a mix of both variable and fixed costs. For example, some utilities may have a set monthly fee plus an additional charge for usage. There are many different techniques that can be used for cost analysis. Some common methods include bottom-up analysis, top-down analysis, activity-based costing, and target costing. The best approach will vary depending on the organization and the specific goal of the cost analysis. By understanding where their money is going and identifying areas for improvement, businesses can use cost analysis to make informed decisions that save money and increase efficiency. And then how is cost analysis done? Doing a cost analysis involves several steps. It's like putting together a puzzle to see the full picture of a company's spending. There are the basic steps. The first steps define the goal. First, the business must decide why it's doing the cost analysis. Are they trying to lower costs? Do they want to compare to projects? Or are they deciding whether to hire more workers? Having a clear goal helps focus the analysis. Second, collect all cost data. Next, the company gathers all the information it needs. This includes bills, invoices, receipts, payroll records, and any other documents that show how much money was spent. Third, group and organize the costs. After collecting the data, the costs are grouped by category, such as labor, materials, utilities, or overhead. Grouping costs makes it easier to compare and analyze them. Then the fourth step, analyze the costs. No, the company looks at the cost data closely. They check which costs are higher than expected, which ones are increasing over time, and which ones could be reduced. They also compare the cost to the value they bring to the business. And fifth, make business decisions. Finally, the business uses what they've learned to make decisions. This might include finding cheaper suppliers, charging how something is made, or reducing certain expenses. Understanding your business costs is more than just good practice. It's the key to making smart, confident decisions. Cost analysis helps you see where your money is going, spot areas to improve, and plan for a stronger financial future. The more clearly you understand your costs, especially, the better you can grow your business. I think it is enough. Thanks for watching.